Hello, everyone. Today on the Final Bar, we'll do our normal Monday routine, which is when we approach the market from three directions: top-down macro, bottom-up stock picking, sector rotation. We'll go through each of those three key areas and focus on some of the most important charts. We've got a lot of movement right now with interest rates going higher, driving financials to the upside, but also gold, precious metals really weakening overall. So we'll talk about some of those key themes as well as the resilience of crypto. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets themselves provide. Focus on the charts, focus on the lessons of price and breadth and sentiment and trend and momentum. Try to understand investor psychology and market dynamics using the most important illustration of those concepts, price itself. When we talk about the markets right now, certainly a choppy day. Friday was choppy. Today was choppy. That's the adjective, I think, that describes this environment where overall it's been net positive, but you had plenty of distribution on individual charts. And as I'm thinking of the stock selection portion of today's show called Shifting Stocks, I'm not struggling to find stocks that are breaking down, things that are rolling over, falling through support, things that are in established downtrends, but I'm also not struggling to find things that are rotating higher. It really is sort of I wouldn't say a bifurcated market because there are plenty of stocks sort of in the middle. It is not one of those scenarios where everything's going up or everything's going down. It's really mixed. And I think the S&P netting into a choppy sideways pattern over the last couple of days is about right, given the trends that we're seeing on the individual charts. Now, we have great guests on the show. It's one of the best parts of this show are all the great external inputs, third points of view that we can bring in. Tomorrow on the 10th, we have Gary Dean from sentimenttiming.com. On Wednesday, the 11th, Samantha Leduc from Leduc Trading. On Thursday, Matt Tuttle from Tuttle Capital Management. Matt is the creator of the first actively managed SPAC ETF, also the FOMO ETF, and many others. Should be fun talking with him. And then next week on Tuesday, the 17th, Sean McLaughlin, options strategist from All Star Charts. Should be a lot of fun. If you missed any of our previous episodes with our great interviews, last week we had Mark Chaikin, Sam Stovall's, some really, really good interviews. Also Andrew Thrasher. Go to StockChartsTV.com. You can see all of our previous episodes on demand. Let's continue on here with our first phase, the market recap. Let's talk about the big picture and what we can learn about this picture as it continues to evolve. So as I mentioned, the S&P in choppy mode, finishing just below the zero level, bit in the red, but mid caps and small caps really driving the way lower with the small cap index. The S&P 600 down about 0.9%. The NASDAQ 100 was actually in the positive, although technology was sort of below zero, actually underperformed today. There were enough in some of those other sectors that are able to bring the NASDAQ above zero. The VIX is around 1675 now. Other asset classes, interest rates continue to push higher. Financials were, I think, the top sector earlier in the day when I checked, down to number 3, but still sort of a quarter point higher on a percentage basis with 10-year yields around 132, and the bond prices using the TLT down just over 1/3%. The dollar index, the UUP, remaining right around 25, not too much different from the end of last week. Commodities continuing their downturn. Energy was the worst of the 11 sectors. We'll dig into the sector themes here in a little bit after the break, but overall, crude oil arguably in distribution mode after putting in a lower high and continue to rotate lower, down 2% today using the USO. Gold prices, silver prices also down as well. So pretty much everything lower. I tell you what is not going lower is our cryptocurrencies, with Bitcoin pushing up above 46,000 here as we're recording the show. And I think that's key. I think over the weekend, the fact that we've rotated above 42,000 and you're continuing to see the move to the upside. We've talked about that range from 30,000 to 42,000. Getting out of that range, I would argue, is very significant. We'll look at a chart of Bitcoin here in a little bit and talk about some of the particulars. We're going to come back to some of the sector and individual stock themes, but plenty of movements all around the board. Looking at a chart of the S&P 500, Again, one of my mentors, Ralph Acampora, always used to say, if you had one thing to understand the overall market and give yourself a bias for uptrend or downtrend, look at the chart of the S&P 500. That's all you need, just the price. And it was amazing to me how often we would just talk about the chart of the S&P in some of our conversations, because that tells you a great deal about just the overall conditions. So despite what we talk about weakening breadth, despite what I talk about stocks that are breaking down and testing support and failing, all those things are not changing the fact that the S&P remains in an uptrend. And I think a trend like this is in place until proven otherwise. Earlier on social media, someone responded to one of my comments by talking about how it's certainly a rotational environment, right? The market keeps going up because there's an alternation between growth working, value working, financials are working one day, energy another, and then you go to another time and it's technology and communication names. At the end of the day, the market keeps pushing higher, and it's absolutely true. We haven't made a new all-time high yet this week. That's maybe the one non-incredibly bullish thing I see on the chart of the S&P 500. That's totally nitpicking. Obviously, we continue to make higher highs every month. We've made new all-time highs and have pushed higher from the previous month. Overall, that is a very constructive chart pattern. That's a healthy tape with the market that's doing well. Again, my concerns are more from the stock picking standpoint and seeing a lot of stocks that are drawing down a good deal, right? It's not like everything looks like the chart of the S&P 500. And I think that's the real difference, right? I mean, I can show you a lot of charts that are members of the S&P 500 that look nothing like this. And the fact that the S&P continues to net out to a strong uptrend is noteworthy. As we mentioned last week, we kind of pointed out the momentum situation, and I would just say July, sort of early into late July, very similar to what you saw in April, very similar to what you saw in January, both of which soon after that bearish divergence where you had higher highs in price, lower peaks in RSI, we saw a pullback of about 4 to 5%, almost 5% at the end of January, just over 4% at the beginning of May, and right now setting up potentially like that May high where you sort of had that bearish divergence. You had one more push higher about a week later, and then it was a pullback. And again, it's not a horrible, dangerous pullback, and it really didn't give up much ground, but it gave enough back to the 50-day that we could sort of reset and continue with this uptrend. On any sort of pullback, my eyes, as with many, will look right to the 50-day moving average for good reason. That has served as support a number of times, pretty much the entire year. Most months, you've seen a new all-time high and a test of the 50-day moving average before a resumption of the uptrend. I have no problem assuming that that trend is going to continue until proven otherwise. And proving otherwise for me would be a break below the 50-day moving average. It's worth noting that if we would do that, I would immediately be glancing down to the May lows. That's about 10% below current levels. I think that could satisfy the August to September seasonal weakness thesis, which I think is a decent one, and would also, over the long term, if you zoom back enough, the uptrend is going to look just fine. So it would sort of satisfy everyone, shake out some of the weaker hands right now. So the S&P overall, obviously in a decent uptrend. I talked about some other asset classes, so let's go there very quickly. So you have financials doing just fine today. When I'm screening on individual stock ideas, a lot of the opportunities I'm seeing are emerging in the financial sector. And we talked about strength in consumer, strength in the healthcare sector, strength in technology in terms of where you're finding stocks making new swing highs. This weekend, as I did it into this morning, I found a lot of charts within the financial sector actually setting up pretty well. And it's things like, BlackRock and T. Rowe and even State Street sort of at or near new all-time highs and rotating back to the upside. But it's also a lot of the other things that look a lot like B of A, and not to jump around too much because we'll hopefully get there when we get to the stock picking segment. Charts like this, which sort of had that short-term pullback overall, setting up to be a potential head and shoulders pattern, and now rotating back to the upside. These are really close to signaling more of an all clear kind of thing. Put in a short-term high or low, now making a new swing high back above the 50-day moving average. A lot of the financial sector actually looks like this. These are mega cap names that have the potential to drive the market higher, but especially the financial sector for sure. And I would say the reason why that chart looks as good as it does is in no small part based on 10-year yields doing what they've done here. In July, you had rates finish that downtrend coming off of 175 down to just below 115, and that's where we finished that down move so far in mid-July, and then again about a week ago. From there, it's only a couple of days ago, last Wednesday or Thursday. From there, we've bounced back to the upside and bounced higher. I think this chart is a really important one to pay attention to, especially given this renewed strength of the financials. Are they the ones that navigate us through this next month or two during a seasonally weaker part of the year. That would happen if this chart continues to go higher. Now, there's no reason why the chart can't go higher based on the technical perspective. I would just say at this point it's still completely unproven, right? At this point, you've made a bit of a double bottom here, and so far you're testing the upper end of this range. We're getting above that last Fibonacci level. I think that was key today. Seeing if that's able to hold going into tomorrow and the rest of this week, I would argue is an important measure to pay attention to here. Two other quick charts, then boy, we got to move on, is gold. So precious metals really suffering. We talked about that on Friday with the drop in gold and testing this support level. They really continue to follow through to the downside. The GLD is now oversold. Once again, we've broken below the low in June. I would argue this now clears the way to 157, 158. That would take us back down to the March lows. That would be back down to this Fibonacci support level, which is around 158. That's a really clear support level to be looking for right about now. That's where I would expect further support and a chance to reevaluate gold. But overall, it's certainly suggesting weakness here, which is as we've now put in a lower high, testing the moving averages from below and now rotating back to the downside. Finally, the chart of Bitcoin, and just the key with this, I would say, is I would at this point suggest this is giving an all clear of sorts back to the bullish side. There were so many things that were wrong with this chart going into mid-July, and it was a pattern of accumulation to a pattern of distribution, lower lows and lower highs, back to the Fibonacci support level and previous support around 30,000, which was an important support level. But overall, the momentum kept getting weaker. And I think that was the most important part of this chart. Look at how every upswing, every month was met by lower and lower peaks in momentum. All of that has changed. We bounced off of 30,000, tested 42,000, pulled back, made a higher low, and now rotated back above it. We're above the 200-day moving average for the first time since May. The RSI is back in a bullish phase, no longer doing a bearish divergence, but starting to indicate higher highs in price. I think at this point, there's a signal that the trend continues. I think holding the 200-day moving average after the break today would be crucial, and that's what I'll be looking for, certainly in the next day or two of trading. Our next segment is sector setups. We've not talked about the big picture, the S&P in a clear uptrend, rates bouncing higher, which is a bit of a headwind for technology, a bit of a tailwind for financials. So let's talk about the RRG chart, and let's look at the 11 S&P sectors and how they're rotating. So on the weekly RRG, which is the long-term indication of rotation, this is telling you the big structural rotation from which sectors and themes are coming in and out of favor. These big diagonal bright red lines going south to west, what I call the direction of deterioration, are all the cyclical sectors. We have energy at the bottom, financials, materials, and industrials. And what that's telling you is on a relative basis, overall leaning away from those sectors has been the right call. That's been the movement of these sectors on a relative basis. What has been working, real estate, which is actually in the weakening quadrant as of today, after spending many moons in the leading quadrant, really the outlier, as most sectors were sort of struggling or either unproven or rotating down. Real estate was farthest to the right, remains the strongest sector, but the momentum's really coming out of it. What you look for on this type of pattern, by the way, is a rotation back to the upside, and all of that happening to the right side of this zero line. That would be a fairly constructive setup. The places of emerging strength on the weekly RRG are healthcare and technology, and I think that's some of the interesting places. Again, when I screen for individual stock ideas, I find a lot that come out in technology. It's places like semiconductors and software, things like healthcare. It's pretty much across the board, but pharma, equipment, many others have tested very, very well and are starting to rotate back to the upside. Consumer discretionary, by the way, is now in the improving quadrant and going up here. When you think about the consumer discretionary versus consumer staples trade, look right here where you see staples heading southwest, XLY, consumer discretionary heading northeast. That's much more constructive on consumer discretionary versus staples, offense over defense. So overall, setting up pretty constructively. Now, the daily RRG, it's a little more into this. We don't have enough time to really go through all the details on this because I want to get to the individual stock charts. But here on the daily RRG, we can start to see that improvement in financials, as I mentioned. You can see the improvement in materials. We're probably not going to have time to go through all of those names, but like ALB, PKG, there are charts that are emerging pretty good, either improving or in pretty good uptrends. So there are opportunities there. And utilities is actually probably scoring the best in terms of heading northeast and strengthening. So if you've not looked at UTs in a while, could be an interesting opportunity to start to do so. Let's look at the 11 S&P sectors here to finish off this segment before we take a quick break. This is a great opportunity to just reset and see what these patterns look like relative to one another. So things that strike me as I'm looking at these charts, number one, just the consistent uptrends in a handful of sectors. The sectors that are in clear uptrends with no major issues that I can see at this scale. The communication services sector remaining above an ascending 50-day moving average. The healthcare sector, same thing. The real estate sector, same thing. Technology as well. Those four are the ones that have been sort of the long and strong, up and to the right, consistent outperformers, all above two upward sloping moving averages. I wouldn't feel bad about general allocations to any of those places because they've been consistent uptrends. Now, where are you seeing rotations higher or rotations lower? Well, very quickly, rotations lower are in places like the energy sector. When you look at the XLE, you can see that while it's looking like a general range-bound pattern, which is what I'm indicating here, the XLE basically bouncing from 46 to 47 up to maybe 53 to 54 times, really getting up to 56 there in June. But that's really been the range. That's been the story of this sector for the last almost 6 months now. But if you look what's happening now, it's stagnant, right? Sort of in the middle of that range, sort of the lower end. And this is, I think, the most difficult part of this chart is the fact that the relative strength is making a new 6-month relative low very, very close to that this week, right? It's rotating downward. So you're really not gaining anything from owning energy on a relative basis. Compare the rotation lower in energy, putting in a bit of a lower high with the rotation higher in the XLF. And you can see why a lot of the charts in the financial sector are actually scoring pretty well in terms of identifying stocks that are rotating back to an upswing, relative strength starting to turn higher. Look how the XLF spent about 6 to 8 weeks below its 50-day moving average, breaking below there in June, testing support at 35 on the XLF, which was resistance back here in March. We tested that again in July. We've now broken back above the 50-day, back above resistance that have been fairly consistent for the last 6 weeks. We've now rotated back to the upside, and we're testing new all-time highs for the XLF. Now, that's driven by a lot of individual names within the sector. We'll look at a couple of those together here after the break, but that's where I'm seeing emerging strength. So in general, when I think of sector rotation, it's using the RRG to understand some of those rotational patterns, but especially keying in on sectors like the XLE that are rotating on to the downside on a relative basis, sectors like financials that are starting to improve. And the question is, do you see follow through on those emerging relative trends? We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the trends of the market together using the power of stock charts, using the power of technical analysis. A couple quick comments before we get to our next segment, Shifting Stocks. Number one, if you have questions for us, send it to us at the Final Bar mailbag. You can get your questions to us via email, thefinalbar@stockcharts.com, via Twitter @FinalBarSCTV, via YouTube. Go to our YouTube channel called Stock Charts. We would love to hear from you. Questions in any of those places would be welcome. Things about technical analysis, technical indicators, particular charts, ratios, market history, market sentiment, whatever it is, we'd love to point you in the right direction. Also, as a reminder, go to stockchartstv.com, use your email address, set up a free account. You can start watching all of our fantastic content on demand from our website, also from any of your mobile devices. Just go to the app stores and search for Stock Charts TV on demand. Our next segment is called Shifting Stocks. We talked about the big picture, the uptrend in stocks that overall continues to persist. We had new all-time highs last week and a choppy market on Friday into Monday, but overall still holding up just fine above that ascending 50-day moving average. Talk about the sector rotation, some of the themes there, energy rotating weaker, financials rotating more to the positive side, and some of those key patterns to keep in mind. Very quickly, what we're going to do in Shifting Stocks here is focus on some of the individual names. The third part of my process after thinking about the big picture, the macro perspective, thinking about sector rotation, is looking at individual stocks. And I'm always screening for stocks making new swing highs and new swing lows. So stocks starting to rotate to the upside or the downside. And over the weekend and into Monday, I look at all S&P 500 constituents, all the members, and look at their individual charts one by one. And I found that to be an incredibly helpful therapeutic process of sorts to make sense of things. We left before the break talking about the financial sector rotating higher. And it's interesting, the chart of BAC is similar to many others that I reviewed this weekend. NTRS, Northern Trust, Citigroup, CMA, JP Morgan, all kind of similar patterns to this, where you had that big run higher. It looks fairly distributive if you take a step back, where you have higher highs into May, into June, and then all of a sudden you have lower highs in June into July. And this certainly is setting up to be a monster head and shoulders pattern that measures a lot lower. A lot of these stocks did not break that neckline. So here you're actually taking the lows from some of these swing highs. We never broke the low of that April low. We did break the neckline, to be honest with you. If you use this level right here, that is totally fair. However, we never broke below 37, never broke below the low from April. Now we're actually starting to rotate back higher. And given rates that have bounced higher, end of last week into today, you're seeing some of these charts really rotate back to the upside. The question, as always, is staying power. But when I'm looking at the tactical time frame, I'm seeing a higher low and now a higher high. I'm seeing stocks get back above their 50-day moving average. The question is, can it hold this, right? If this is a downtrend and this is just a bounce before the next leg lower, the RSI most likely fails around 60, which is right where we're at. The stock would most likely not get back above its 50-day moving average, which is right where we're at today. So I think these are key charts to pay attention to. I think I'd love to see, if these are able to push higher. So for example, B of A getting above 42 really completes this rotation from short-term bear move to short-term constructive move. I mentioned Northern Trust. So a lot of the charts are kind of looking like this, where they've put in, a lower low, but all of a sudden putting in a bit of a higher low. And the question is, do they have enough gas to rotate back to the upside? As always, those previous lows are the support level to pay attention to. It's all about staying above those. Now, other charts in that group, like State Street, come to mind. A little different configuration. There are stocks that are breaking out just fine. And in general, breakouts like this, where you've had a run into a significant resistance level, you sort of hit that level, bounced off of it a number of times, and now potentially breaking out to the upside. That's a gap higher on Friday, pushing higher, continuing to the upside today. I find that to be a fairly attractive technical setup in general. Those are the types of breakouts that I'd be interested in keen on following. Within the communication services sector, a couple charts to pay attention to in terms of weaker charts. Often there have been times when it's been difficult to find charts that are in distribution modes. I'm not struggling to find those today. And I think within communication services, the video game stocks are pretty good examples of that. ATVI obviously going through a lot of issues right now with lawsuits and things. But overall, from a purely technical perspective, this is a chart that's rotated from a bullish phase to a consolidation phase, and I would argue now very much a distribution phase. Broken down through support, and I think that level around 88 to 90, which is support through much of the year 2021, failed. The 200-day moving average failed, and it's continued to rotate lower. I'd be keen to see if it's able to hold some of those previous lows, and it might be helpful in this sort of situation when you're retracing back into a price range to look at the Fibonacci retracements. You'll note that we broke down through the 38.2% retracement. The 61.8% retracement is on 70.50. That lines up beautifully with the November low from the end of last year. That might be a downside target to pay attention to, as it's oversold right now, bouncing up a little bit into the weekend. But overall, a chart that's certainly leaning more negative than positive. Disney is a key one. Now, this is a company reporting earnings this week. That's Thursday before the open, if I remember right. But overall, I think at a key juncture, right? This is a stock that had been in a pretty good uptrend. The uptrend stalled. It's now testing previous support, testing the 200-day moving average for the first time in quite a while. If Disney's able to hold the 200-day, my faith in the overall equity environment is probably restored. You feel like things are holding, that things are rotating back up from key support. I'm finding a lot of stocks testing their 200-day moving average, by the way, not just in this sector, but across the board. So stocks like this holding their 200-day, I think would be very, very important. Obviously, this is a name that has come off quite a bit, and earnings could certainly be the catalyst to propel this out to the upside, which would be around 185, or to the downside below 170. I think either way, whichever way that breaks, that would be the direction of movement from there. In terms of other earnings names, it's a lighter earnings week relative to previous, but a couple key ones. eBay coming up later this week as well, but an NIO, which is sort of in that group with Tesla on Wednesday. But 3D Systems, DDD, actually reporting today after the close. We don't have time to pay attention to the earnings right at the moment, but this is a stock that has just bounced off its 200-day moving average. I would be very interested to see if that's able to hold, given what sort of report we get today. I have to look at Tesla when we're talking about shifting stocks, because Tesla is obviously one that a lot of people pay attention to for good reason. It's hard to deny that this is really starting to rotate from a consolidation phase to more of an accumulation phase. You've seen the higher lows in Tesla. You've seen it break above 700, which I would argue as the key level. That was the resistance from June. We tested it again in early July, came back from it and bounced off of the 200-day moving average. We've now broken above 700, and we're holding at this point above that level. Holding 700 maintains the bullish positioning in my mental space. Maintains that bullish thesis. We break below 700 though, and I would very much question the uptrend here, and the support or the validation that the uptrend is over and the downtrend is in place, in my opinion, is a break below 650. That's the 200-day, also a trend line using those recent lows. Now, when you're talking about Tesla, I immediately think of the ARK Innovation Fund, ARKK, and looking at where we're at with that. So this is a chart that is certainly not broken, right? It had been in a downtrend. Now it's sort of regained some of those previous losses and really in a sideways trend, really in a consolidation phase. We're now between Fibonacci support around 110 to 112, and also the previous lows from March. We're up to resistance around 130. That was resistance in March, April, and again in June. I'd be very interested to see a break above 130, similar to what we talked about back here. Clearing that 130 level and breaking resistance would be quite bullish. We've not done it. We actually failed in that attempt in June. That's, again, what I'd be looking for. So while the bounce is interesting, and over the last week, the appreciation is encouraging, getting through that final resistance level, I think, would be key. The last thing I would just say is the reopening trade certainly struggling. We don't have time to go through charts like Expedia, cruise lines, things like Carnival, Wynn, the gambling stocks, the airlines, DAL. They all look kind of like Expedia, which is rotating down through key support levels. Expedia breaking down through its 200-day, I think, was key, and a lot of charts in the struggling downtrend and in the reopen trade. Some of those travel and tourism stocks that I mentioned. That is shifting stocks, focusing on some of the key themes. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the XLE, the energy sector. We talked about how certain sectors were in solid uptrends, things like technology and others. Charts that were starting to rotate back to the upside, things like financials come to mind. You also have sectors that are not performing very well on a relative basis. Now, energy is obviously struggling along with crude oil prices, which have put in a lower high, and now rotating lower down a couple percent today using the USO. The energy sector potentially making a new relative low for the last 6 months. I think that's a key chart to pay attention to. Just like some have been able to, Bitcoin was able to make a higher low and then rotate back to the upside. Energy is sort of like the Bitcoin chart flipped over and breaking down through 47 would be sort of like Bitcoin breaking above 42,000. In this case, would be quite a negative signal. We talked about Bitcoin earlier when we were in our macro discussion, and I think this is a beautiful rotation from bearish phase to bullish phase, and I'm seeing plenty of signs of accumulation. The higher low to 3,800 is encouraging. The fact that 30,000 held a number of times and now rotating back higher is encouraging. The real, sort of actionable signals are breaking above 42,000 and staying there, breaking above the 200-day moving average and staying there, which I would think is currently the most important measure to pay attention to. And the RSI, which has rotated from a bearish phase to a bullish phase. I see a lot to be impressed with on that chart. Now, that's interesting because Coinbase has its first earnings report, or next earnings report, as it were, tomorrow, Tuesday after the close. And I think that's an important one to pay attention to. Gapping higher today, closing up around 280. Now, this is interesting because it's back above the IPO price, which was around 250, breaking above 260, which was the high from the end of June, put in a higher low in mid-July, another higher low about a week ago. Now it's rotating back to the upside. We're nearing Fibonacci resistance around 292. That would be the level I'd be looking at relative to earnings. Does this earnings announcement propel Coinbase to become overbought for the first time, able to push above and continue this follow through above previous resistance, or does this short-term uptrend stall and come back down? Overall, based on the charts, I think the evidence is leaning more positive than negative. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.